from IPO to billion-dollar pipeline, Symal has had a huge first year on the ASX. Its CEO Joe Bartolo and Salter brothers Greg Taylor talk growth, government spending, and where the next leg of value could come next. But I will say that Salter Brothers has built a reputation for being quite selective and long-term in its approach to small-cap investing. So we've got two of the market's hidden gems. I began by asking Greg about the qualities he looks for in small companies before investing.
Pretty consistent with how we look at the market, and so ultimately it starts with people, and so really spend a lot of time understanding the management teams, the quality and the alignment of those management teams with the shareholders, and do they hold equity themselves, and a lot of things like that. But beyond that, we look for businesses that have a defendable market position. So it's not always deep technology with intellectual property, but they've built up a market position that cannot be easily displaced. But then if we get a little bit more qualitative, away from qualitative into quantitative, we're looking for businesses that are growing at double digits. So they're growing their revenues and earnings north of 10%. We want them to have strong balance sheets, so they're well funded, and we want them to be attractively valued, so cheaper than the market. So it sounds pretty hard, it sounds like Nirvana, but they are out there, and excited to speak about a couple of them today. Yeah,
well, that's what I was going to ask, because are there plenty of opportunities in the small end of the Aussie market now? I suppose companies that haven't seen their share prices rocket already, is it difficult, or are you finding those Nirvana, utopia kind of companies?
Yeah, no, it's still actually quite attractive environment at the moment, and some really telling statistics continue to be cycled out, but the market hasn't really responded. So like the valuation differential between Australian large caps and Australian small caps is still at 20-year extremes, i.e. the discount that small caps trades to their large cap peers is as large as we've seen in decades. And so that's happened. What you've started to hear a lot of positive sentiment around the small cap sector, but it's largely been found in the resource sector. Gold and resources have had a really strong run this calendar year, like some sort of once in a cycle returns, but that hasn't been reflected as yet really in the industrial sector or the more traditional industrial and technology businesses. And if you look at what are typically the drivers for small cap outperformance, it's measured around interest rates and the direction of interest rates, and we're now in an interest rate reduction cycle, and so it feels that all the things are set up for a good outlook for small caps over the next couple of years. But pleasingly, the small cap industrials haven't really ran as yet, so there's plenty of opportunities.
All right, so I guess that's why you couldn't pick between your favorite children, and you brought us two companies today, starting with the first one. What is the first big idea?
Yeah, so the first one is a company called Symal, and we tend to look for opportunities that are not well known and not widely held, and Symal only joined the ASX via an IPO late last year, so a relatively new entrant to the ASX, and isn't well held across the traditional small cap universe. So that in itself creates opportunities, but it's a diversified services business that started in 2001, over 25 years ago, as a more construction business, but has evolved into a diversified construction and asset hire business, and and more broadly in diversified services. So really interesting company, not well known, and got some really strong fundamentals to it.
Welcome, Joe Bartolo, Managing Director of Symal. Thanks for joining us.
Thank you for having me.
Just give us a 60-second elevator pitch for Symal in your view.
Yeah, we're a diversified services contractor. Started, very humble beginnings. It's the old wheelbarrow and shovel sort of story. Started in the landscaping sector and diversified the business into who we are today. We do have a contracting division within our business. We have a newly formed electrical division as well. We've got plant hire, recycling. We've got a few quarries. We're a whole sort of mixture of businesses, but a very vertically integrated business and a self-performing model as well. but yeah, up and down the east coast of Australia, in 14 different locations, and we've grown a big business from zero.
Wow. Well, okay. And in your first year as a listed company, exceeded guidance across earnings and net profit. So how do you maintain operational discipline across all of those geographies, all of those different sort of sub-units, and still continue to grow?
It's all about the right people in the business. Like, we've got an amazing bench of, high caliber people throughout the business. I love to say it's all me, but it's far from me who does all the hard work all the time. I like to steer the direction, but then we've got an amazing team that actually deliver what we need. We set really good expectations to our teams, and we've got STI sort of framework and LTIs in place to ensure we get the best outcomes. Really good with client relationships, repeat clients as well. All those types of things will help to ensure that you sort of achieve what you need to achieve.
So I think about 2 billion or approaching 2 billion of project work in the pipeline. Actually, that's work in hand, isn't it?
That's work in hand at the moment,
And a strong pipeline, presumably.
Very big.
Where do you see the most compelling growth opportunities? Like, into what sectors?
Yeah, so we're heavily focused in data centres at the moment. So we're providing those concrete works and civil works in that data centre space, and we've been doing so for the past sort of 10 years. In addition, power renewables are a really big part of our business, and working anything to do with wind, solar, battery storage. And so that's where we see a lot of the growth coming from. In particular, power renewables are probably the biggest part. Road infrastructure, ports, airports, and so on always seem to be available for us to tender or win. A lot of community infrastructure projects as well. But yeah, the opportunities are huge. In addition to that, sort of circa $2 billion worth of work in hand, we've got about 1.5 billion of ECIs that we're involved in at the moment. So,
sorry, ECIs for
early contractor involvement.
Okay.
Yeah, so,
just for us playing along at home.
No, it's all good. So that's where we're virtually tendering a project, getting paid to tender a project, one out, and where we can convert those into jobs. And we've got a 90% previous strike rate on those conversions. So very positive for us. The forward work order book is huge at the moment. And
so, Greg, when you hear that, I sort of perked up at data centers, as I'm sure lots of our viewers have as well, because it's been such a hot thematic in the market. Are there any parts of the business that are most attractive that you would like to see them as an investor in the company, really develop?
Yeah, no, I think there's real opportunity for that geographic expansion that was touched on as well. So, guys have done an amazing job to date along the eastern seaboard, and we're all aware of the Brisbane Olympics coming up, and there's going to be a lot of projects and development spend in that region. So I think the ability with their broad suite of services and really strong relationships and track record to take advantage of that opportunity. I guess the other areas that we really like about the business is the strong balance sheet. So it's a net cash, as at 30 June, circa $40 odd million of cash. That have made an acquisition since, but the opportunity to use that balance sheet to broaden, whether it's geographic or skill set, that service offering to keep driving that double-digit growth is really interesting to us.
Well, that's interesting. So what is the growth strategy? Is it inorganic or organic? Where do you put the emphasis?
Yeah, a bit of both. Our biggest focus at the moment is through inorganic growth, through acquisitions. We are looking at all different types of businesses that can really complement what we do, and anything that we can integrate well into our vertically integrated model is what we're after. So if you look at what we're doing now with the power renewable space, which is pretty important. We're doing the civil balance of plant works on those projects. We're starting to do a lot of electrical balance of plant works as well, but it's probably a smaller part of our business. So, what sorts of acquisitions we can make to actually complete that. And then furthermore, it's about, in the utility space as well. So we're actually starting to do a lot of recurring revenue type work as well in the utility space. What can we do there to continue to grow on that in different locations throughout Australia as well. In terms of organic growth, it's about establishing the offices in the right places, and then obviously having a tendering team and a full blue-collar workforce in those areas as well to continue to grow. And using our clients. Many of our clients will be based anywhere throughout Australia, it doesn't matter, but they've got locations like we do. So we generally follow those clients around to actually continue winning more and more work. So then we also have the innovation piece as well that we like to talk to, which is really our third pillar of growth. And that's all about what we're doing in the recycling space as well, and how can we continue to grow our offering in that space.
Mm-hmm. Greg, from an investor's perspective, the board has emphasized capital discipline, which you're happy with the balance sheet, also dividends.
Yeah.
So how important to you as an investor is that balance between reinvesting for growth and then returning capital to shareholders?
Yeah, no, I think the guys have got the balance right, and at the moment they're offering, based on the current share price and earnings outlook, looking at a fully franked dividend yield north of 5%. So an attractive dividend yield, which I think is sort of appropriate for this stage of company and the growth rate. That's a nice bonus to have. But our real attraction to this business is, at the moment from a valuation perspective, it trades at a price earnings ratio below 10 times, so single digit price earnings ratio, when almost without exception all its peers are somewhere between 15 to 20 times PE ratio. So significantly undervalued relative to peers. But if you look at the balance sheet, the quality of management, the alignment of management I touched on earlier, board and management own closer to 70% of the shares in this company. So that they're believers and they're very incentivised to get the outcome. But again, double-digit earnings growth, really strong balance sheet, 5% plus yield, trading at north of a 50% discount to its peers. So we think the real opportunity over the next 12 months is that capital growth and it being recognised rightfully as good or better than its peers, and that's going to present significant share upside for investors.
Sounds like a hidden gem,
I
at
believe
least
so.
in your view. Joe, then if we check in with you, say a year from now, what's the one milestone that you'd like investors to be able to look to say that Symal has proved Greg's investment thesis right?
Yeah, for sure. Look, we've like Greg was saying before, we've been in the market since late 2024. For us, it's about delivering what we say we're going to deliver. So doing exactly what we say we're going to do, and we've been doing that to date. I think with all the acquisitions we've made, we've bet prospectus guidance. We're generating cash well. I think what any investor's going to look at Symal in a year's time is, that unbelievable growth that we've been able to achieve and continue with that and delivering exactly what we say we're going to deliver. I think that's most important.